Hi, everyone. I'm Rick Bensignor. Today is Tuesday, June 16th, and welcome to the In the Know Trader show for this week. Well, as we start off today, recording late morning on Tuesday, the S&P is up about 54 points at 3120 off of a 3153 high. So it has sold off, but nonetheless, it's still up about 1.75% on the day, as lots of good news came out overnight regarding the virus and some potential, I won't say cures, but certainly some medicine that seems to help reduce the mortality rate for those who are on ventilators. So the market likes that. Retail sales came in well, and that gave the market another good boost, and that's why we've got a good day going. Let's take a look at some other markets here. U.S. 10-year is up to about 75 or 76 basis points, so it's up 5 bips on the day. We'll talk about that a little bit later. Crude oil is just about unchanged after being up almost $2 higher from here. So it has given back a lot of its gains. And I'm actually trading crude oil as I'm recording the show. I've got some futures positions on, so you may hear me click a few buttons along the way because that's me trying to get out of some shorts I have on that right now are panning out very well. And gold is up about 5.5. August futures is at 1733, but still runs into trouble north of 1750 every time it gets there. So that is something that also, traders need be careful and watch out for, because there's only so many times we can kind of go back and forth in the range, and eventually this range of roughly 1680 in gold up to 1750 needs to get resolved. We've been there for a month, give or take, and there's a lot of new long speculators that have come into that market in the last month or two. Much money, and I get concerned that the longer it takes to break out towards the upside, the bigger the chance is that there's some type of pullback. Nonetheless, gold is up $5 on the day. Today's agenda is going to be slightly different than the last few weeks, because last week, with all the information and stuff we were talking about the markets, we never got to look at the banking sector, which is, I wanted to look at kind of the 12 big banks, both money center and regionals, and we never got to it. Just time ran out on me. So this week, I want to make sure that we have time for that. So the bulk of the show, after we do our general market overview, will be on on these 12 banks, and that'll probably take us, the full half hour to get to. So we're probably not going to have a trader education portion this week, simply because I want to make sure. I promised you last week I would go through these names. We ran out of time, so we will do them this week. All right, so let's progress from here. As I start off more shows, I talk a little bit about just how to get in touch with me. It's rick@intheknowtrader.com. And of course, if you go to intheknowtrader.com, you can see lots of videos that I've put up over time about trading psychology, interviews I've been on. And of course, the whole reason I created In the Know Trader was to give you, the individual investor, a much better insight into how institutional portfolio managers and traders actually approach the market, and when and where they make their decisions, versus purely using charts that are more kind of basic, simplistic, and don't really capture the essence of what the institutional community is doing. And you do want to know what institutions are doing and have yourselves aligned as best possible with what the institutions are doing. So that is what we do in the Know Trader. Let's take a look at the macro sector relative performance like we do most weeks. The slide on the right is through last night's close, year to date, and the slide on the left was last week through last Monday's close when we did the show Tuesday. And we always compare market movement to see really what are the biggest movers, what's going on in the sectors. And This week, we see that 9 of 11 sectors have moved at least 1% in relative terms to the S&P. And to me, if you move 1% or more, it's noteworthy. And so we take a look each week. The red dots mean they have fallen at least 1% in relative performance to the S&P. Green dots mean they have gained at least 1%. So we have two gainers in the last week: commercial services and technology. Have added. Tech was up almost, looks like about 2.5% relative to where it was a week ago. And when we look at the ones that have underperformed, we see that consumer discretionary gave back about 1.3%. Industrials, let's see, 5, 8, that looks like it gave back about 3.5 or almost even 4%. So bad week on the industrial side. And of course, Boeing is one of the major names in the industrial space and one of the biggest weights, if not the single biggest weight. And the way Boeing's been up and down, although mostly up, we're seeing some real movement there. Energy, which had been the best performer last week, gave back over 7% this past week in relative terms, and it's still nicely outperforming since I upgraded the sector in the middle of April, but it just gave back a good chunk of that over the past week. Of course, the past week includes last Thursday's major decline, where oil got hit for several dollars, and you saw the XOP and OIH and any of the energy-related names kind of get whacked pretty hard along with the market at that time. And then we have some more minor changes across the other places, though financials, take a look at the next to last column. It was only down 12.44% last week. It is now down over, 16.8. So that took a hit of almost 4.5% during the week. And of course, that was a reflection of interest rates having come right back down from, remember, they got to about 95 bips on the 10-year, came right back down to the low 60s. And with Fed Chairman Powell telling us that he's going to keep rates at zero for the foreseeable future, that was not particularly taken well by those investors who are in the banking space. And banks, of course, need the yield curve to widen as much as possible. So you need the 10-year to really widen out significantly more than it has in order for banks to be able to do what they do, which is borrow short, very short term from Fed funds, and which are virtually at zero, and then loan them out at longer term rates. So when you take out car loans and home loans and all those things, they're making money on the spread between what they can borrow the money for and what they can lend you the money for. So banks always want to see a really nice steep yield curve in order to have their earnings grow and become highly profitable. Okay, let's switch to our charts. And here we're going to start with the S&P like we often do. And I want to show you that we now, based on last week peaking and then having the significant sell-off, we at least now have a reference point to draw a downtrend line from the all-time high. And this is, I had been arguing for a few months that we would not make new all-time highs without at least having some significant high come into place that was lower than the all-time high. And certainly it all happened very quick, but we had the significant decline in the market last week, where the S&P went from 3233 down to, I don't know, in round numbers, what was it, 2965 or something like that on this week's low before bouncing. And you can see we're kind of come right back to this old prior line I drew that connected the tops, and that's kind of where the market is right now. So in general, we ran out of steam into our preferred selling zone. Things would have to get a heck of a lot worse for us to be able to come and buy it down here into the preferred buying zone, and I'm not sure that's going to happen. But at least, my theory is that this yearly high and the low that's already been made in 2020 was going to stay the high and the low for the balance of the year. And so we'll see now. Obviously, we had a real good comeback and we'll have to see what transpires. And if we take out this high, then of course you only have the gap remaining. I don't know how strong resistance the gap will be, because I would think that if we take out the high at 30, what was that, 32.33, then the news has turned much better once again. And at that point, I'm not sure if all-time highs are going to hold us, but at least we've got the theory right here that you had to make some type of important high before declining and having some chance to get back more towards. It doesn't have to be the complete middle of this pattern, but at least not just keep going and going the way the Nasdaq did. So the S&P, although cap weighted, is not configured the same way as the Nasdaq. Plus, the Nasdaq composite Nasdaq 100 has a built-in mechanism to how it's actually calculated, such that it dumps out bad performing names and adds good performing names. So, the Nasdaq 100 is always going to look like a thing of beauty in a bull market, because they're always going to just keep putting in the best names into that index. So it is not a reflection of the whole marketplace by any means, nor is the S&P 500, in the sense that the top 20 names in the S&P are probably close to 50% of the whole index, or something like that. I don't recall exactly what it is, but certainly the mega cap names is really what drives this. Let's also take a quick look at the U.S. 10-year. Sometimes the Zoom software, covers over my pointer. Okay, so here's the 10-year. We spiked up to, the mid-90s, and then we came right back down. But notice that looks like 4 days ago, the pullback actually marked a 13 for downside exhaustion, and it happened to come when we were right at the bottom of the daily cloud. So for short-term traders, that's something that I would typically play for a trade. We'd have to properly get back above 76 basis points to, again, target the mid to high 90s. And then ultimately, it could be as high as 1.41% if yields really bottomed and the 10 years, took a leap to the upside. You'd probably have to have pretty big inflationary concerns and other things going on for that to happen. It's possible with new stimulus packages, you get that over time. But at least, from a trading point of view, again, you had the 13 the other day. You had a 13 and 9 combination here back in early April, and it really never traded beneath there. And not that you made much money, you would have had the patience of a saint to hold this all the way through just to get that one pop, and then you would have had to be very good at getting out at the target levels when they happen. You had 1 day and 1 day only for that, for you to been able to work on that. Here's gold miners, again, something we've looked at this multiple times. We can look at breakouts from either the hyphenated line or the solid line. Either way, when this got above kind of 32-ish, it hit its targets up here. You can see the propulsion targets. Just missed that one. Hit the closer one, 36.67. We got to just about 37.5 and pulled back. And as long as we hold, to me, it's kind of somewhere we could use even this level, the propulsion exhaustion level on the downside. As long as we hold above roughly 29.5, I'm okay. And even taking, some drawdown on this, simply because this really should lead to a 6-year pattern that breaks out to the upside, especially with the clean out that it had on the downside beforehand, really should lead to higher prices over time. So if gold can resolve itself to the upside, then I think that gold names will follow in suit and move higher. So I still like that sector. And I think that's all we're going to look at for now before we start looking at the banks. So let me see. Where do I have? I thought it was already here. I must have looked at something else. So let's just go to a spider chart, switch it to our first bank, which is Bank of America. I'm going to take the cloud chart away because this has gone sideways enough that it hasn't really helped. So here's a weekly chart of Bank of America. Your highs, the March lows, and the comeback since. It's come back and kind of faltered right into this consolidation zone. We're still holding above the uptrend line, so do this. Let's add propulsion here, and let's see. Okay, so there's a bearish propulsion level here at 2457 that has not been broken properly. So that means that we've had 3 weeks that it's kind of rejected it and moving up this week, which is both good and bad. So let me explain this here. If I can get my chart to, there we go. So you can see 2457 is a place that if we properly close underneath, it would then suggest a test down to 20.13. So here's the way you kind of look at this. The fact that this is staying above here is potentially bullish. You're in a 5 count this week, so your setup count is still alive towards the upside, which is a good thing. You could target a move up to 29.25-ish or so if this gets some legs. However, here's just the flip side of it. If this week closes above last week's close, and then next week we close beneath 2457, and take out and then the following week take out this low here at 2369, then you have a good chance or you up the chances that this thing comes back and tests somewhere near the lows. Which, all in all, I'd say this, we'll look at lots of other banks. Bank of America, I don't have a clear reading on. I like that MACD has turned around positive, but that would kind of be the case in almost any stock now. If you don't have a positive MACD after how much the market came off the lows, that would be a problem for many stocks. There's also plenty of distribution that took place over the last few years here. So if I bring in, come on, chart. It's not the chart. It's the Zoom software that kind of messes up. There we go. So if you see, you had a couple years of some distribution here, and we took out the 2018 Christmas low on the March low here, where it broke under all these lows, but it's come back. This could easily be here. Let's put up a long-term moving average. Here's your 200-week moving average. So you're kind of right near it too. I just don't see a big VIG here in this name. So for the time being, I'm fairly neutral on it. Let's look at Citibank. Totally different. Hold on a second. Here we go. Here's Citibank. Bottomed on a weekly 9. Also come back somewhat towards its 200-week moving average, but you can see here we are at 54. There is let's zoom in now, this is somewhat similar. A couple weeks in a row, we've held above this line. I mean, to me, that's kind of my stop out. A Friday close underneath this probably gets me to get out. So if you like the name, you got about, 10% downside risk to play for maybe double the upside to come back to the 200-week moving average, or even this target here at 67-ish. So a slight positive bias to the name, nothing really special here. And of course, if we go back to what I had mentioned before, you have to think about how banks make money. And the biggest way they make money is by lending or borrowing themselves short term and lending longer term. So they need to have that yield curve be as lofty and as spread apart as possible. And with short-term rates at 0 and longer-term rates, in and around 75 basis points, it's traditionally low, and they do much better when it's multiple percent. Then they kind of print money. Now they're more struggling to come up with clever ways to make money. So minor bullish bias here, but nothing particularly that screams to me that I have to buy this name here and now. JPMorgan. Everybody seems to think of this as the premier bank, and I've been a Chase client myself for years. So here it's trading again kind of near a slightly positively angled 200-week moving average, but nothing special. Also, same thing, a few weeks in a row, it's traded beneath its propulsion bearish level, but never got the signal. Last week we actually closed, looks like right on it. Here we're up slightly on the week after opening lower. So still a minor bullish bias here, but not much. And same type thing, I'd say if today's Tuesday, if this week closes, let's see, actually, you get a clearer signal if this week closes up on the week relative to last week, and then next week closes down beneath 99.72. Then I have a little kind of harder time holding on to this name. And as far as resistance, I mean, you can do Fibonacci number stuff like that, but from other models, not in the basic camp. I'd say perhaps, a test up here between somewhere north of 120 may be a place to take some off the table. Again, the bank charts are just kind of very moderate. And if you look going back over a couple of years, you're still lower than the average price from the last couple of years. Wells Fargo. So here's a bank that's going to look weaker than most, has had lots of trouble. And so this peaked in 2018 and it's been down since. So also, if you look at how many, just go back on a weekly chart here and you look at how many years of sideways pattern there was here, it doesn't have to stop kind of at the bottom end here. But look, that if you come up on a rally, if this thing gets back to the low to mid 40s, you should have plenty of resistance at that point. Your 200-week moving average probably going to be right into that same zone too. So if this name got a good rally up, I would be a seller. I see no reason to own this, given how much overhead supply there's going to be from people who are in this name, who are trapped for years. And so this goes back to, let's say, 2014. You have 6 years of buyers who are trapped in this name that even a guy like Warren Buffett, had loved this name for a long time. And I think a lot of people get in and do what he does. And therefore, to me, I look at this, I say, you've got huge overhead supply. I just don't see this as being worthwhile as a hold. So I would take advantage. It's only a hold to try to take advantage of rallies to get out of it, but this is not a healthy looking name. What comes next? Goldman Sachs. So here's generally what's considered the darling name in the investment banking space, and they've gone into consumer banking with their Marcus bank. So this thing has failed on the rally also against its 200-week moving average, fairly similar to other ones in the sense that recent action has gotten closer touch to it. You do have kind of a two-step thing here. Be interesting. I bet you it's not far that on the lows, we probably got very close to what would be equal legs down. So if we take a look at the height or the dollars of that decline and take it off of this decline, and bingo. I mean, it almost exactly hit. Came within just a couple dollars of doing an equal legs move down. Come back. I mean, at this point, Goldman, we can draw a trend line. And don't forget, in their own way, these guys are banks too. Not in a classic sense, but it's an investment bank, and they've gone onto the consumer side. So they want to see wider yield curves too. It benefits them, and you can see in general there's certainly some longer term support. In fact, here we go back to 2013, and you can see we have 1, 2, 3, 4 hits down at just shy of 140. So, that's really good long-term support. But up here now, north of 200, and anything, I'd say from current price up to even 240. And I realize that's, potentially, what do we got, 40 on? Well, percentage-wise, that's a good amount, but I just don't see anything special in the chart to make me say that I love it at this price. If it got down here, perhaps at 186-ish, 187, down near its propulsion. Notice how much stronger this is because it's not been playing with its propulsion bearish level. So if it got down here, I'd probably be a buyer. I think that would at least entice me to dip my toes. Morgan Stanley, my ex-home, where I spent 10 years of my life. So this is actually better in the sense that it's well above its 200-week. Kind of a longer-term double top up here. Actually looks healthier than Goldman does at this point. And same thing, if it came down to 44-ish, which it's not been far from recently, it's probably worth a little dabble into. So I would at least lean towards Morgan Stanley right now better than Goldman. Here's U.S. Bankcorp, well beneath its 200-week moving average. Looks like there's a whole bunch of old lows somewhere down there. So at least those acted as resistance, come back above, kind of hanging here too. I would say looking at years of overhead resistance from 2017, 18, and 19, that let's say the bulk of that is, 50-ish, give or take. I would look for this to spend some time in between where it's trading now and not get much better than 50. Because again, you've got trap sellers that you would have to be very committed to this name, that if it came back to 50, you wouldn't kind of say, gee, have a loss like it was trading at 30. And so I suspect there'll still be overhead resistance. So a lot of these names really are not great looking names at all, which is not surprising given what's going on with yields. PNC Bank topped out at its 200-week moving average. So it's slightly, if you think of this as an M-shape type pattern, long-term double top comes back to higher than where the M was, but stalls where it has, and it's pulled back. Hard to see that there's also a heck of a lot of upside relative to where we just topped out of. So this too should probably spend time in here. No particular reason that makes me think that this is a great buy. This at least also kind of stopped against, multiple lows going back several years, but it's got huge overhead supply. So I can't tell you that, at least down at 113 is a heck of a lot better than it was a couple weeks ago at 130. But let's see, you got a little tiny gap here off of this Monday's low. Honestly, not a heck of a lot here to say. What else? Let's kind of finish up with Capital One. Capital One's on a weekly 9. So look how often this turned on 9s. Just I'm looking quickly. 9 low into a 13. This 9 didn't help. That's a 9 bottom. That's a 9 top. That 9 led into this 13. 9 high, 9 low, 9 high. Same thing. Overhead supply. It's probably reached about as much as it's going to go. It may get up towards 90-ish on the next rally, but I don't see it taking out highs. Not with yields the way they are. And one last name we will do is, let's pick one. Let's do TD, Toronto Dominion. And similar picture to some of the other ones we've seen. This is well beneath its 200-week moving average. So probably good bottom, but nowhere to go on the upside. So, well, I don't say nowhere, but I mean, if it got up to its 200-week, I'd be a happy seller there. And so all in all, we're going to finish here now. All in all, banks are completely mediocre looking, and probably a sector that you don't want to put a ton of new exposure into for now. That's it for the week. I am Rick Bensignor. This has been In the Know Trader.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.